Welcome back to the channel, everyone, and thank you for tuning in. Okay, today I want to discuss with you something that will probably help everyone out, okay, because it helped me tremendously. It's something I practice in my day trading each and every day, and it surrounds the idea and the principle of stop loss, okay, in the sense of protection. All right, doesn't matter if you trade with a hard stop or not, a middle stop. It's all, really you need to know before you get into a trade, size up that trade, where you need to get out at, protect yourself, all right? Whether it's you got your hand on that close button and you know that the moment the market crosses a certain thresh, you're closing that trade out, all right? Or you got a hard stop. Placing hard stops sometimes can be tough because we need to provide the market a sense of room, okay, an area into which it can test, okay, because the banks, those institutions, the market makers, they are trying to stop traders out. They're trying to collect areas of liquidity, and they know areas where they want to run. And that's where what makes a difference of someone when you start to really practice and perfect this craft. You start to understand what's truly going on behind the closed doors, the curtains, all right? But today, I just really want to address the idea more so on stop loss protection, prevention, knowing what to do quick enough to be able to get out of a trade. The signs of a weakness or fake out once the market taps into a zone. I trade supply and demand. Most everyone here trades supply and demand. Maybe they have their own twist or their own edge built around it. When I say this, I mean over on our Discord community. Not everybody now. I'm not saying every single person trades supply and demand, but we all trade the future markets, okay? And that's what this channel is surrounds. That's what we discuss. So if you're someone that's interested in becoming a member on the Discord server or community, find the link to the Discord down in the description portion of the video. Click on it and invite yourself in. It's free, okay? Come over and join us on the trading floor. Again, the trading floor, or if you're someone that has general questions, you're new to the future markets. Again, we primarily trade the indices. It doesn't matter if it's the micros or the E-minis, but either way, that's what we primarily focus on the Discord server. Okay, so again, in this video, I want to just give you a tip, a trick, basically a tip that you can look for. First signs of a fake out, in a sense, where the market may test a supply or demand area and it's just ready. It's really ready it's ready not to reject that area. Okay, it may just collapse. All right, meaning that it tested it, it bounced, and then it comes back against you. A lot of people get frustrated when they see things like this unfold, and then they quickly start to feel, oh, the strategy doesn't work, or their strategy doesn't work, or something they've been using doesn't work. It's not that, guys. You got to understand one thing. Not every trade is going to work out, and you got to know when to cut your ties quick enough or soon enough to get out of it so you're not, blowing through your money. It's all about protecting your capital in the end so you can get into the next trade, the next successful entry, and watch, make up for the difference of what that small amount of loss and gain some. So again, at the end of the day, I always talk about being green. It is extremely possible. There are people who are part of our community and they're green after green after green every single day. All right. And I know people are frustrated because they may be not at that area there, but there are tons of individuals that are part of our community that, have left their old ways or old habits and are finding success today over within the community. So if you're interested in joining the community, again, the link is in the description. So what I want to show you today is that when the market gets back to a zone, I know I was kind of breaking into an intro, guys, but now this is the real meat of the substance of the today's lesson at hand, in a sense. Something that at least I want to show you. So in the market, let's say this is a demand zone, okay? Now, this is not giving a rundown of the strategy that I provide in tons of the videos. I go into things in detail. I don't leave you hanging or lingering or having to want to buy into a trading course or your mentorship, because I don't have any of that, okay? I just simply want to pass what I know for to help other individuals out, all right? So let's say this is a demand zone right here, okay? And the market has tapped back into it, all right? And it rejects the area, okay? And when it comes to like stop loss placement, where I talk about, okay, well, there's a couple places you can put your stop loss, right? At the back end of the area of demand, if you choose to, but sometimes that demand zone may be a big area, so you have to really be mindful about that, okay? It could be, 1 or 2 candles or 3 candles, whatever the case is, but this case here is not. But this again, this area could be a big area to where maybe your stop loss is way back down here, and then you don't want to. You want to protect your capital, especially if you're someone that doesn't have a lot of money, okay? You got to place a small amount in your brokerage account, or you're only able to leverage but a small amount into the market. So getting stopped out maybe somewhere way down here below may be very devastating to someone, okay? But anyways, the market taps into this zone here, right? So you can put your stop at the back end of this area of demand, right? Or for better, placement, what you could do is wait for the market to tap into that zone. And I always talk about what? The break of a candle, meaning the close of it in the opposite direction. This last bearish candle, what you see right here, probably can't because of that box. But right here, the last red bearish candle, once the market closes above it, we go long, right? But the moment we go long right here, okay, it does go up maybe a few points there. What are we talking? Maybe 2 points there before it pulls back. And this is where a lot of people get shaken out of the market. They get scared, okay? Especially if you don't have, enough capital to really trade with, because you're all about protecting your capital. And you're thinking, okay, now the market is pulling back against me, and then it may stop you out if you put your stop right here. So a second place where I always talk about putting your stop is at the back end, where the rejection took place at, and that candle finally closed above. So at the back end where it started to push higher, okay, before the actual break of the candle, that'd be another place to put your stop at. But you have to understand this too, is that you don't never want to run it tick to tick at the back end here, okay? You want to give it some room, all right? So if you put your stop loss, say for instance right here at 62.5, and the market came back, it came all the way back down to 61.5, 4 ticks, it stops you out, and then it moves in your direction. You've got to be able to understand one thing about trading. You can't trade with a 2, 3, 4, 5 tick stop. You've got to give it some room, all right? So you're going to have to put away some capital to be able to play this game correctly, all right? So a 4 tick stop is going to definitely stop you out. And basically, they know, okay? The banks, institutions, the market makers know where people are putting stops at, okay? Traders are. So they know you put it right here, they're going to stop you out to collect even more, hitting sell stops, to collect even more liquidity to basically fuel themselves up to push the market higher, okay? Now, look what happens. It comes back, pushes up, comes back again. What do you think happens right here when they bring the market back again? Well, they are grabbing liquidity. It wick right below this area here, right below this little level, and then it takes off to the upside. You got to understand what's happened. For those that have been trading for a X amount of years in your season, you already know that, where the possibilities lie as far as where the market could test, all right? You know the market could test here. You know the market could swipe right below here. So you have to have and practice proper stop loss prevention and management, okay? Stop loss management to know where to put that stop loss at, okay? So again, those that are experienced with seasons know what I'm talking about, okay? Now, let's say, for instance, you got into this trade right here, okay? If you really are someone that's really, reserved and you're very conservative about your style or means of trading, then what you're going to do is, what I typically could do if a trade is not moving in my direction quick enough, it pushed up here after the break, right? One candle close to the downside. When it starts to either attempt or break with the close of the second candle, I'm out, okay? So think about it this way. Let's blow this up a little bit. You got into the trade, right? You got into the trade right here at 66.25. It goes up to, say, 69. Maybe you took out there at 3 points, okay, if you're comfortable doing that. But I'm aiming for the tops up here more than likely, okay? But you got to be mindful because this is a supply zone right here. But it's a zone that's already kind of been tested in a sense, meaning when the market was breaking down, creating this supply zone right here, all right? It was already kind of tested. So, I look at things like that, look at the possibilities and the probability of the market probably pushing higher. I want to take out this high because we were already bullish, all right? So I will take the attempt more than likely to at least try to take the trade back up to this area here and maybe hold a runner back up to the high up here. But that's not what this video is not what that's about. This video is for you to understand what to do in event the market does it or turns around and it goes against you, okay? All right, and you get scared. You chicken out of the trade, okay? We all do that, okay? We're all chickens at some point when we jump out of the trade, right? So when it comes to preservation of your capital, your money, you can, if you see this first bearish candle to the downside and a follow-up with the break of the second one, typically if I get a second candle pull back to the downside, I'll go ahead and get out the trade because it's not moving in my direction just to protect, if you have a hard stop on, or this would be the back end right here would be my area where I know for sure I need to go ahead and get out the trade. Now, sometimes the market will just come down and swipe the back end of this area of demand, which is a liquidity grab, and push higher, right? But if it's not enough momentum fall up to the upside, then I'll get out the trade, especially if it starts to close with 2 candles, back to the downside. All right. But what you see a lot of times is they'll do that and then it'll go up in your intended directions. But it just depends on how the market is actually moving and paying close attention to price action as well. So if you're someone you see and you want to protect your capital and be more conservative, and you see that the market starts to, the moment you get into, say, a long position, or it could be a short position, and it starts to, in this case here, close with red candles, 2 or more to the downside, and then, and let's say you had your stop resting right here at the back end of 62.5, you may want to go ahead and get out the trade to protect or preserve some of your capital still, to where you're not getting fully stopped out. That's what this video is about. It's about stop loss prevention, in a sense, not getting fully stopped out and then even losing even more capital by taking a early loss, okay, rather than taking one later. Okay, again, it helps protect the amount of money to where you're not getting fully stopped out and losing more money. Okay, so when you get back into the next trade, you can go ahead and make up the difference of maybe what you lost on a prior trade, and then make a gain. Okay, that's what it's about being green at the end of the day. But those are seasoned to know what took place when it came to price action back to the zone. You would know to kind of hold this trade, especially when the market came down here. Say, for instance, maybe you got into this trade, you got out. Then you saw it setting itself up again and said, okay, this thing could be really trying to just grab liquidity to push to the upside. And that's what they were doing there. The market didn't quickly move with great momentum to the upside, started moving sideways here. They were basically just fooling traders out here by doing this, bringing the market back here, stopping traders out below this area right here, grabbing liquidity, boom, blast to the upside, right? All right, so that's an example there. So the overall idea here is if the market is not moving with quick enough momentum, okay, and you start to see the market breaking back down, then go ahead and get out to trade to preserve your capital, right? And sometimes you may, you get frustrated here to where you got out the trade and then it worked in your favor, right? Trust me, we all experience that. That's something in part of trading that it's hard to detect, and it's hard to know that it's always going to happen that way. It's just all about preserving our capital and then looking for the next setup or entry to get into. Okay, maybe you got into this trade again. All right, when you saw what it was doing here. Okay, you saw bullish momentum. Stepping back into the market. And then you got into the trade again and took it back to the top there. Okay, and so if you got into this trade here, and maybe you got in here when it came, grabbed the area liquidity there, you got in there at 65 and ran all the way back up here to 80, 83. You did very, very well on that trade there, okay? So look what happened here. It goes up there. We get a structure break above this area here at 83.25. And then this is a demand zone. When I see stuff like this, I see a major structure break to the upside where we're just continuously breaking structure. It takes out this high right here, okay? And then it took out another high right here on the break to the upside. And then it starts to pull back. This is a retracement or a pullback, but I'm going to go ahead and mark off this demand zone. There's a void right here or a gap right there, okay? Small little gap of void. If you don't know what I'm talking about, I've covered that in multiple videos. Please go and watch those videos on the channel. And watch all the videos. I mean, there's 600 of them, but, you can also become an elite member too and, kind of bypass having to watch all the videos, because what I did was I pulled out and packed in a list of videos for videos that I felt like were the ones that were cover the most pertinent information, that give a rundown of the strategy and how I use it as a whole. So, you don't have to watch 600 videos. I pulled out the videos that, again, that provide the most valuable content or information and put them together for the elite members, okay? So if you want to become an elite channel member, then go over to the YouTube channel where you're already on it right now. Just find that join link, click on it, and you can sign up for the elite channel membership. Again, it's called the elite channel membership. There's 2 tiers there. Through the YouTube membership program, it's $6.99 a month. You get the trade breakdowns where I go in detail about the covering trades that I've taken. It's basically me just kind of walking you through and providing you my mindset and thought process behind my trades, as well as that video breakdown or that video playlist of videos that are just cover the valuable content, the meat of what I'm talking about, okay? $6.99 a month. Click on the join link on any video or the join link on the homepage if you choose to, okay? All you're doing is just supporting the efforts of me as a content creator, pushing out this content with the hopes to see other people become inspired and do well and succeed in this business. All right, so the market runs to the upside here. It pulls back to this demand zone here. Clear area of demand. Well, look what happens here. It breaks below the area of demand right here. Now, this is a swing to the upside here. There's a small little area of demand right here, okay? It did break below it, okay, as you can see right here. But still, what it did was there's a swing right here where this little demand zone came out of. So, you got to kind of monitor that if you know what you're looking at and you see something like this kick off right here and you got into this trade when you got the break of the candle above, two bullish candles form to the upside. You wait for the close of the break, the close of the candle above this last bearish candle go long. So let's say you got into the trade right here at 70. Typically I'm going to go ahead and get in because I'm an aggressive style trader. After I see this bullish candle here, and then I see this next bullish candle right here where this long wick and then that hammer at the top there, that's a massive sign that there's lots of bullish momentum in the market. So I'm gonna get in here, say it's at 68 and a quarter. Once I get into that trade there, it's just all about knowing where to possibly get out the trade. This is an area of structure right here or supply area where the market pushed down, pulled back, and pushed lower. Now, it actually tapped into that area and it rejected it. So you got to understand price action as it's retracing back to this demand zone right above is a key area of supply. So it goes up there, taps into it, rejects. This is the reason why you need to understand market structure and price action as well. Okay, so we get the first candle close to the downside, bearish. Next candle, maybe you got the trade, okay? So maybe you got in here, say at 68 and a quarter, okay? And then the market pulls back. It closed right here at 67 and 3/4. What, you lost there, what, 4 ticks, okay? Versus waiting for the market to do a full-on stop at the back end right here at 64 and to where you maybe lost 3 points, three additional points, okay? So it's all about stop loss, preservation, prevention, and management as a whole. All right, so the market retraces back, and you got to understand, ultimately, where should you possibly maybe want to put your stop loss at? Again, right here. There is a demand zone right here, and if you put your stop at the back end of demand, it ran that area, right? And you got stopped, okay? You got stopped, all right? Well, if you got into, well, first and foremost, I should say this. When it pulled back to this area of demand, more than likely, let's see here. Yeah, you got stopped out because when you enter the trade, say right here, okay? All right, maybe your stop is right here, and then it comes back and stops you out. Again, the second place where you can put that stop loss is right here at the back end of where the momentum started picking back up once it rejected the demand zone back to the upside right here. So you put it back in at 64 and a quarter. It doesn't come back and hit that stop loss area, but that is a big area. Let's say you got in here at 68 and a quarter. Your stop is sitting back here at 64 and a quarter. That's a 4-point stop right there from your entry point, okay? All right? So, again, if the market ran higher, you got in, and then you basically, when you saw this rejection right here, this is what's called a fake out. Bearish candle closed again, the second one there, you got out, okay? You preserve your capital by only taking a 3 or 4 tick loss there versus having to pick up another, 4-point area of loss there, and the market comes back and stop you out fully, okay? So you want to get out sooner than waiting later, all right? But if you know what took place here, look what happened. The market continues going to the upside, all right? So let's take a look at another example because I want to show you where the market actually broke through one area and tested another area. Look here. We are getting bullish activity to the upside. Higher highs, higher lows, okay? This demand zone on market right here, pay attention to it, okay? It breaks higher, breaks structure, pulls back. There's an area of what I classify as weak or low probability right here, this demand zone right here, okay? Because when the market broke above, it came back and it filled that void or gap immediately. So I'm not saying that it can't reject this area again right here, but you got to be very careful because it's already tested. It's not an untested area. This is untested here. There's a void or gap resting right here back at the demand zone, okay? But we're talking about stop loss, okay? So again, where can we possibly put our stop loss? The back end here at demand, of the area demand, or we could put our stop loss once the market taps into the demand zone, okay? In this case here, you see this wick right here, wick right below that area demand. When I see a wick right below an area or above an area, below an area demand or above an area supply, and then I get a major bullish candle where is a major wick right here, followed up with a hammer to the upside, followed up with another bullish candle. That's an aggressive sign of strong momentum push where the market wants to push higher. I'm going to get in right here for me at the close at 25 and a quarter, 25 and a half, because I'm an aggressive. But I'll talk about waiting for the break of the candle above, to get in, meaning that last bearish candle to the downside, and then getting in, okay? But if you're more conservative, now what that may do is it may not get you in at the best entry point, but that doesn't mean the trade is not still going to go in your direction, okay? It may pull back, because the market may get 3 or 4 bullish candles to the upside, and it's going to pull back. It's going to pull back before it pushes higher. That's just, them faking traders out, okay? So let's say you got into the trade, okay? It pushes higher, all right? It bumps up against, some areas of resistance right here, and then it pulls back. You got 1 candle close, 2 candle close right here, and maybe you got out, okay? But your stop loss is resting down here at the bottom, right? Right here at the bottom. So if you got in, let's just say here, I don't know, maybe around 28 and a half, okay? And then the close of this candle right here at 29 and a half, all right? And you got out because you got chickened out, or you scared because you saw 2 bearish candles close to the downside. You still were above the break-even point, and you closed in positive versus closing in the red, all right? Your stop loss sitting down here, okay? Down here at 22 and a half. Or maybe you put it up a little higher, okay? But if you know what's taking place when the market retraces back to the zone there, then you'll know to stay in the trade, okay? But yeah, when you see some bearish activity like that, yeah, of course you're going to get scared out. You're going to, again, you got in here around 28 and a half, 28 and 3/4, and the market starts pulling back against you, all right? If you didn't get out on that second close of that, the close of that second bearish candle, then it's starting to come back against you and breaking below your break even. Even if you got out right here, say 27 3/4, you only lost 4 ticks, okay? You got stopped out, 4 ticks, all right? It's better than getting stopped out and waiting for the market to come down here at 22 and a quarter, all right? And taking on an additional 5 points there, all right? So again, getting out sooner than later. We're talking about stop loss management, stop loss prevention, knowing when to get out of the trade quick enough. All right. So this zone right here, it didn't hold up. Even though it is a low probability demand zone, it didn't hold up there. So you have to be mindful of key areas of demand, even within a swing like this right here. This is internal structure. The market was moving lower, making lower lows, lower highs, turns around, makes higher highs and higher lows. Break structure here above this major structural point right here at 34 and just say a half, okay? Breaks above there. This is a demand zone, but this is a high probability demand zone. So this weak zone here, I'm going to wait and just see if it's going to break below and come down in this area here where there's a high probability zone, and it's around the original area where the market started to push to the upside before it broke structure. So we started collecting momentum for the market to push higher. So pay attention to things like that. I talk about taking entries and looking for the better entry point back tucked within the major area structure or swing right here at the lower end of it where the original buying took place. On the flip side, it could be where the original selling took place. So again, this is just kind of a rundown to show you how you can protect yourself in means of your stop loss, giving you areas of examples where to put your stop loss at so that you can preserve your capital at the same time. But yeah, that's what I wanted to share with you guys today. If you are not a current subscriber here on the channel, please take the time to go ahead and sub. Share. Click on the share button and share the videos with your friends, your colleagues, your family members, okay? Just want to get the community growing, okay? Because I go into detail about things that, have been helping traders, okay? Whether new or experienced traders. So that's the purpose and reason why I've been making these videos. So share the videos. Click on the share button. Like the videos as well. Please drop a like on the video right now. Stop what you're doing. Drop a like. Hit that thumbs up button. Also, subscribe if you haven't subbed to the channel by clicking on the sub button down below. And do one of the biggest things. Make sure you have all your post notifications turned on so you never miss one of the uploads here in the channel. That's all I have for you guys. We're going to the weekend. I wish everyone a safe weekend, and I'll see you rocking and rolling on Monday for all those that are part of the community.